What would be your overall assessment of the U.S. economy and its recovery at this point?
The U.S. economy is in a really strong position. The COVID pandemic has obviously devastated so many sectors and really injured the economy, made a deep hole, if you will. But I've been very pleased with the momentum, the underlying momentum of the consumer and of businesses who are eager to get back in, eager to engage in activity now that we've got the vaccination rates climbing and it's safe to go out. So I feel really positive about our future. Of course, that depends a lot on two factors. As goes COVID, goes the economy. So ensuring that we continue to keep COVID at bay and we can beat back the Delta variant, et cetera. The other thing that it depends on is that the globe comes with us. It can't just be the US only. We are very dependent for our own growth on the growth of the rest of the world. And so we live in a global economy, and the health of our future really depends on the recovery of every country, not just the US.
Mm-hmm. You just mentioned the progress of vaccination. Could you elaborate on that? How helpful was the progress of vaccination in the recovery process for the US economy?
It's been really the fundamental factor. As you probably know, we were in various stages of lockdown, a national lockdown for the depths of COVID, but then different states, California only opened about a month ago in terms of re-engaging in full activity. And those abilities to open, that ability to stay open, depends entirely on the vaccination situation and whether we have the ability to continue to get vaccinations, continue to sustain our growth in vaccination numbers. This really is essential. We have found that when people are vaccinated, they feel more confident, the economy, people in the economy feel more confident, and of course, we lower the death rate and the terrible illness that comes with this disease.
Right. What was your take on the June jobs number?
Well, I was pleased, of course, but I would caution us all against the idea that 1 month of job numbers a trend makes, right? So we've seen disappointing, people have said, well, this is disappointing news some months, it's been good news other months. The way I like to look at it is take a 3-month average, and really we're creating about a little bit over 500,000 jobs per month. And that's really a healthy progress. But if you took those kinds of numbers and you just thought, well, how long would it take to get back to pre-pandemic levels? It'll be all the way through the end of 2022. So a long way to go, very positive numbers, but a long way to go before we can say we have recovered.
I see. You talked about the 3-month period to see what's really going on. And this morning's June CPI report showed 5.4% year-on-year increase, which is more than market expectations. What was your reaction to that number?
Well, these pops in inflation, as I'm going to call them, they are anticipated. Sometimes the numbers come in a little bit higher than market participants forecast, but basically we expect these next several months to have these higher reads, higher prints of inflation, if you will. And there are a variety of factors. The simplest one, of course, is what people call the base effect. It's simply that in the depths of the pandemic, you could get an airline ticket for very little money. And now airline tickets are returning to their full value, pre-pandemic value. That causes a big increase in the price. But that increase doesn't keep going. It just gets to the pre-pandemic price level and it roughly stays there. So
yeah.
This is going to happen. But we also have supply bottlenecks. As you know, the global supply chain is not fully back to health. And those disruptions, when demand's picking up, cause temporary price inflation, temporary price pressures. But I think if we look through those, again, what we'll see is that underlying inflation is firming, which is good. That's what we want it to do, but it's not at the levels that we're seeing in the June print or even in the monthly prints we expect to get going forward.
This is somewhat related to the previous inflation question, but as far as I'm concerned, you're the only Fed official who has indicated a link between low inflation and the progress of globalization back 2 years ago in March 2019. Has your view changed since then?
No, not at all. You know, it is tempting, and all of us do it, to focus only on the pandemic and sort of discount or think the world has completely changed. And many things in the world will change, but the fundamental forces that shape the economy are still with us. So what's an example? Globalization. You know, countries know that they do better when they trade with each other. So they trade with each other. So global supply chains may move around. We may find that firms say, well, I need supply chains in multiple countries, but they're still going to recognize that trading with each other makes all countries better off in terms of growth. So that's not going away. Another thing that's not going away is technology. The technology allows us to have just-in-time inventory management or to know the price of a good or a service anywhere in the globe, not just in the United States or in your case in Japan. So these are things that haven't gone away. And of course, we have a global aging population and slower productivity growth. Those are both fundamental forces that slow the rate of growth globally, put downward pressure on the neutral rate of interest, and give central banks everywhere less room to work to get inflation up to the target. So there's global downward pressure on inflation. And those factors haven't changed. They just have gotten a little bit hidden from the fact that we're all putting our resources towards fighting the pandemic and making sure that people can recover through the pandemic. But we're going to be back to the job of fighting inflation from below our target once the pandemic is over.
Do you agree with the view that the housing market is getting a little fuzzy? And if so, what can the Fed do to address that?
So that's a very interesting question about the housing market. And I'm going to just give you an example from my own district, the 12th district in the United States, which is the 9 Western states. So I'm sitting here in San Francisco, and person after person will complain to me that their housing value fell because people wanted to move out of San Francisco during the pandemic because cities didn't feel as attractive. And a lot of people moved to Idaho, which is a place where the housing market is so hot that the people who originally lived in Idaho are finding it hard to buy homes because people from California are moving in and paying higher prices, and housing prices are rising rapidly. So monetary policy is very poorly equipped to manage these regional differences. So what our job is to make the overall economy really one that is on a sustained expansion, so we can achieve our dual mandate goals of price stability and full employment. And the low interest rate environment, the accommodative interest rate environment, has really helped spur the housing market along with other markets for other goods and services. People have been able to buy homes. They've also been able to refinance their homes, which is a very important mechanism in the United States for increasing disposable income. So these are the important reasons why our policy is quite supportive of economic growth. But the regional variation you see in housing prices and housing valuations really has to do with where people decided they want to live and how much housing supply is currently available.